Our weekly live Q&A, and it's true, I started the live stream a couple of seconds early, not by much. I see the clock ticked over to 7. I was just so excited. I hope you all are doing well. I hope you can give me a thumbs up in the chat, to let me know you can hear and see me. I'm actually doing a couple of things here that won't really affect you, but helps me. All right. We got a lot to talk about. Like I'm going to get to the questions soon, of course. But yeah, we've got a lot to talk about. I see Phil, thumbs up, Jim. Oh, I think Jim gave me a clap emoji. So I got that going for me. So where do I begin? Okay, number one, yesterday I did a video about a really cool is the wrong word, very useful mutual fund screener offered by Fidelity. You don't have to have an account there. Here it is. I'll show it to you. And I took the video down after a couple of hours, and I'm going to show you why. So the video was just about the mutual fund screener, but I talked about a very specific mutual fund that I was all excited about, ready to buy. And I'll just show you how I found the mutual fund and then why I took the video down. So I was looking for basically a something like a Vanguard life strategy fund. I didn't want a target date. I didn't want the asset allocation to change. I wanted the fund to invest in low-cost index funds. So in the Fidelity mutual fund screener, I selected allocation funds, which gives you, as you can see down here, over almost 1,500 funds. That's a tad more than I'm interested in. So I said, well, let's just limit it to Fidelity. All right, 89, good. I can get behind 89. And then I decided to sort it by net expense, lowest to highest. And I see these here at 3 basis points. There's the gross fee is kind of what they can charge you, but they're offering the fund at a discount. And unless they disclose specifically, you don't know really when the discount's going to end. But 3 basis points is a lot better than 13, but obviously very low cost. And I ended up focused on this one, growth allocation fund. It's perfect. This is basically a 3-fund portfolio wrapped into one mutual fund. It's perfect. Love it. And we can even look at what it invests in. This is Fidelity's total market, stock market, U.S. market fund. It's like a VTI, but it's Fidelity's. Developed, it's kind of like VXUS from Vanguard, same thing. Their U.S. bond index fund, it tracks, I think, the same Bloomberg U.S. aggregate bond fund. They have a little bit in short term. Anyway, so I raved about this and then published the video, raved about it. And then a kind viewer emailed me and said, Rob, you missed this right here that says you can only buy this in very limited circumstances involving a health savings account. Now, I've never seen that before. Not that I've seen everything. So I didn't want to confuse people. I put a comment in. I said, no, people are going to, this is a great fund. People are going to go try to buy it and they won't be able to. And I don't want to do that. So I took the video down. And this morning, I emailed my contact at Fidelity, and I said, here's the ticker. What is it? FRGAX. I said, here's the ticker. Is it true that you can only buy it in certain HSAs? And they wrote back and said, we don't know anything about this fund, and we can't find anything about it. Why don't you check out our mutual fund screener tool? So I wrote back and said, well, actually, that's how I found it. And here is the Fidelity page where you can find information on it. And I sent that to them. And they never heard of it. Now, admittedly, it's a new fund. It was launched in February. But they said, yeah, I guess we've never seen this before. But apparently this is what do they call it? Oddly specific fund, just for HSAs. Actually, not all HSAs, only certain apparently employee-based HSAs. Anyway, so I took that video down. I didn't want to confuse folks. What I ended up going with is, I'll show you. Well, actually, I can show you. I can use the Fidelity Fund Screener tool, I think, to show you. Let's see if it's in here. It should be. We got to get past, maybe it's not in here. I guess it's not in here. That's interesting. I must have some criteria set. Let's get rid of this. And this. Can I just search for fun? I guess not. Huh. Oh, that's because I limited it to Fidelity. That's why. Let's go index, and I'll find it this way, I think. This is a fund many of you are familiar with. Here it is, Vanguard Balanced Index Fund. So this is basically, it's only 7 basis points. Here we go, only 7 basis points. And it invests about 60% in Vanguard Total US Stock Fund. Although unlike some fund of funds, they actually invest directly into the stocks that make up the fund. They don't actually, this fund doesn't actually own VTI or VTSAX. Yeah. Anyway, and US Aggregate Bond Fund. So it doesn't have international, but this is just for my retirement accounts, my wife's rollover IRA and my rollover IRA. We have international exposure in our taxable account. And what I'm going to do is add exposure to tips in 2 other retirement accounts. The net of it all, is that for all of our 7 retirement accounts, every account will only have 1 fund. So that I'm happy with. And I think it's a portfolio that I can tell my wife, if something happens to me, you can just let it go for a really long time. You know, you could spend literally years thinking about what you want to do. I am going to try to work on the investment spreadsheet that some of you have downloaded so that it can track fund of funds. So you can actually, for a target date retirement fund or a fund like the one, like this one here, that has multiple asset classes, you can separate out the percentages in each asset class. And I've got an idea of how I want to do that. But be patient with me. I'm working on it. All right. So that's sort of an announcement. We're talking, I want to start a little bit about inflation and interest rates. Did you see the market? I'm looking for my phone. I don't even have it with me. So let's see what stocks did today, just briefly. Ugly, right? They've got Michael Saylor from MicroStrategy, who's basically turned his software company into a Bitcoin ETF. It's not doing so well. So what we've got, the S&P was down almost 4%. NASDAQ was down 4.68. These top ones here, I don't own AOR, but my Apple stock was down almost 4%. Berkshire 3.5%. Bank of America 3.5%. It was a bloodbath. Deere 3%. How did ARK do? ARK was down 8.8%. Ford's down 7%. Look at that. It's got a PE of 4. I've been tracking Citibank. It's down over 4% because it's selling its book value is like under point. It's under 1/2 its book value. That's what it's trading at, which seems crazy to me. I'm not really interested in yet another bank stock, but boy, let's see. It's trading at 0.52 price to book, and that's and I don't know if that factors in today's prices. It says as of June 13th. Yeah, so I guess that is as of today's prices. Here it is, by the way. So a lot has been going on with inflation. We probably already know the headline number, 8.6%. They announced that last week. These are some of the categories. Of course, energy, as we all know, is huge. It's been up significantly. If you drive a car that runs on fossil fuels, you know all about that. But even food. I mean, when you look at the chart, food, all the others don't look so bad compared to energy, but look at food. Whoops, didn't mean to do that. Let me refresh this. Year over year, it's up over 10%. That's, most of us need to eat. So, yeah, inflation has been rough. And I was noticing, so the 10-year treasury, the 10s, what's the yield on the 10s? We'll look at CNBC. It's up more today, 3.362. I think it was roughly 3.25 this morning. Of course, it wasn't that long ago. Here it's like 1.8. Even more recently, 2.75. So, the 10s are up significantly. Now I was checking out mortgage rates. Not that I'm needing to borrow money, but this is just from the Google machine. A 30-year fixed, 6.387. Yeah. That, if you're in the market for a home, things have gotten, a lot more expensive. And so just a few comments about all this, and then, we'll turn it over to you guys. Oh, and I do have one other question to ask you. Don't let me forget. I have another question, important one. Well, important to me. The first thing is, none of this should be unexpected. And we've been talking about this for a long time, that we didn't know when interest rates were going to rise. If you think back, well, I've started this show a year and a half ago, but even the live stuff. But we've been talking about how when interest rates go up, asset values go down. It's just, it's like, it's about as certain as if I drop this pin, if I let go of it, it falls. Yeah, it's not always quite that certain, but it's generally inevitable. As my civil procedure professor would say, is day follows night. Yeah. Anyway, Professor Dan McLeod, boy, he was a great one, passed away. Anyway, so we know that when interest rates go up, asset values go down, and we're seeing that, right? We get to live through history. I guess we always live through history, don't we? Anyway, we're seeing it happen, and no asset really is spared. I guess certain energy investments, perhaps, but we've seen it with stocks overall, bonds overall. Obviously, crypto's been a disaster. I don't own any, but I know probably some of you probably do. How's gold? Is gold? They say Bitcoin is digital gold. I think we know that's not true now. At least it's not true right now. It hasn't been true. What has gold price done? I don't know. I guess it's down. Yeah. I mean, nothing is safe. But my first takeaway is this is how the markets work. I mean, it may not be fun to live through it, but this is what happens. We can look at certain things in our environment today that we would say are outside the norm, but the general concept that interest rates go up and down, inflation fluctuates, asset prices fluctuate. We had historic low interest rates. Now they're going up. We don't know for how long or how far. And during that time, asset values come down. And this will eventually change as well. It does, I think, force us to really think about our portfolios. Now, in my case, I've changed nothing. I bought those funds, but the asset allocation is basically the same. So I haven't changed anything. But, I hear a lot of people say, well, I want to be 100% stocks. Okay, well, this is what it's like to be 100% stocks, and could get worse. Long term might be okay. But if you're fairly new to investing, if you started investing after 2009, we've had some downturns end of 2018, obviously for a few weeks when COVID hit. But I think this one feels like really the most significant event in the markets since the Great Recession. So now you get to start to feel what it's like to have a 100% portfolio, or at times, right? There are good times when you have a 100% portfolio. If you're big into growth stocks, 6 months ago, I got tons of questions about QQQ. And my answer is always the same. It's reasonable as part of your portfolio. You just have to understand that you will go through, the further out you move from a core portfolio, you could have extended periods of significant losses. What's the QQQ done for the year? Can't be good. Let's see. Go to performance. Year to date, it's down 27%. So it's basically wiped out the gains from 2021, right? But you had nice years here. So that's just, it's the reality of that approach to investing. And so, my way of dealing with all of this from a portfolio perspective has always been, I'm going to sound like a broken record. Low cost, well diversified, have a plan, stick to it. That's what I've done since 1993. And I think it's the best approach. A lot of people don't go that route. I've got a text from a good friend today about hedge. And I don't hedge. Now I do take other steps. I actually think the best steps you can take to weather storms like this have nothing to do with your portfolio. You can get your low cost portfolio, well-diversified portfolio in place and just leave it there, but keep your debt as low as possible. Not easy to do. If you have a lot of debt, obviously you can't just snap your fingers and have no debt. But long-term, as part of your overall financial plan, if you have little or no debt and you're not investing on margin with leverage, that right there alone makes weathering these storms much easier. spend below your means, even in retirement, at least to a point, are probably and certainly before retirement, are probably two of the biggest things. And I like to try to keep my income producing options as open as possible, even if I'm not actively working a 9-to-5 job, which I'm not. I could go get a number of different jobs if I wanted to. I want to go back to the practice of law. My work in the sort of online field, I could, do all kinds of things. I'm not going to, but I could if I had to. To me, those are probably the best ways to deal with both emotionally. You have all those options. It makes getting through difficult times much easier. And then, of course, if you had to, you could actually use those options to generate more income or reduce your spending or both. And that's my approach. So I imagine today I'll get all kinds of questions about, well, should we do this or should we do that, or should we invest in more in real estate, or more in energy, or and to me, changing your portfolio or trying to come up with the perfect right allocation for this environment or that environment, there's only so much utility you can derive from that kind of approach. I've actually started to get questions about risk parity, because the idea of risk parity is you have assets that will do well in just about any market. I don't know if that would qualify. I don't know if there's anything in this market. I guess energy, maybe. But I wanted to look up real quick, and then I've got a question, and then we'll get to your questions. I got a question for you, and then we'll get to your questions. I'm looking in Portfolio Visualizer. I still want to check out gold for the year, and actually is relating to the question that I have. So this is 10,000 in gold starting in 1972. I guess they don't have any data for. Oh, they do. So, okay. So for 2022, I don't know how well you can see that on the screen. According to Portfolio Visualizer, gold is up 0.11. And so if you had some amount of gold in your portfolio, it would have certainly, it could be your best performing asset, actually, right? And that kind of gets me to my question that I want to ask you. I get contacted by all kinds of advertisers. Most of them I ignore. One person I actually took a phone call. It's a gold IRA company, and I spoke to the CEO for about an hour. And I told him, I said, yeah, I don't invest in gold. I think a few percent here and there, but I'm not a big believer in precious metals. However, I know a lot of you, or a lot of people, are. So my question to you is, and let me see if I can do it so I can add a poll. Here's my question. I'm going to put this in a poll here. If you're listening, you'll only be able to respond to this if you're listening via YouTube. And before I ask it, I'll give you another example. I got an email from a company that allows you to buy fractional shares of art. And I've probably received 30 or 40 emails from them, and I've not responded to one of them. These sorts of I don't know if you'd call alternative investments, they just seem to me like unnecessary. But here's my question, and it really isn't specific to whether I should partner with one of these advertisers or not. Are these the kind of topics you want me to cover? Would you like me to review, I don't know, the top 3 or 4 precious metal IRA providers, and their fees and their pros and cons, or or not? So I guess I'll say, should I cover alternative investments? That's how we'll phrase this. And it's yes or no. Let's see if it works. I got no's already. All right. I think, an error occurred. Try again. All right. I'll try again. I'm getting all kinds of no's, so maybe I don't need to run a poll. Oh, there it goes. So you can vote now. All right. While you're voting, I'll go to your questions. From TD55, what do you think of the Vanguard fund VHF? Well, if I know it, I don't know it by the ticker, so let's look it up. I'm not sure Morningstar can find that fund. I wonder if the ticker is wrong. Check the ticker, TD. At least in Morningstar, it's not coming up. Let me try and Google it. Vanguard VHF. Oh, it's financials index. Why is it not coming up in? Why is it not coming up? Huh. Anyway, so if you want exposure to financials, I think it's a really good ETF. I've not studied it in depth, but just generally I understand what it does. It's inexpensive. It's 10 basis points. You can see its 30-day yield is 3%. If we look at the portfolio, it's probably going to have Berkshire. Maybe does it have Berkshire in there along with a bunch of banks? Let's see. Yeah, Berkshire, number one holding. See, that I know. I don't know that some Fidelity funds can only be bought inside an HSA, but I did know that Berkshire would be in the top 10. Anyway, JP Morgan, Bank of America, Wells. So this is, as some of you know, I own Bank of America and Wells Fargo. I wanted exposure to banks because I thought they were good investments, and that was over a year ago. And they've done well for me. Even they've been down a lot here recently, along with everything else. But one approach I could have taken, and I think it would have been a reasonable one, would be this ETF. Yeah. So, yeah. So I like it for exposure to the financial sector. Oh, I mentioned Bank of America and Wells Fargo. I also own Berkshire, so I own three of the top four here. So I guess I have some exposure to financials. All right. Whoops. So this actually, Chris, I'm going to beg to differ. There's one way in which this is not 1929 all over again, and that is inflation, right? Inflation was actually quite low. It's specific to 1929. Inflation rate by year. See how far back this goes. Not what I wanted. Oh, maybe it is. No. The balance. Well, maybe the Minneapolis Fed. Oh, yeah. Okay. This will work. So in 1929 itself, yeah, let's look at this. So the inflation rate is this column to the far right. So look at this. 27 minus 1 is deflation. 28 minus 1.2. 29, the year the market crashed, 0. Minus 2.7, minus 8.9, minus 10.3, minus 5.2. And even here, really low, and then the war, right? So in that sense, 1929 is very different, and that's important for those in or near retirement, because if you're going to adjust what you take each year by the rate of inflation, which I think most retirees probably don't actually do that. Although I don't know that I have data on that, just my gut tells me that. But if you're going to do that, it turns out that 1929 or in the years around that period weren't the worst time to retire, even though the market crashed by about 90% from 29 to 31. And it's because there was deflation. You could actually you could withdraw less and less and less for a number of really key years when the market was down. And that actually helped. The worst time to retire was in the late 60s, in large part because of 10 plus years of inflation at, say, 6 to 12%. In fact, we can even look at it. Lots of ones in here, the 60s. But see, we get to 68. And what's interesting, in 66 was a rough year. Notice, though, the inflation in those specific years isn't the problem. I mean, it's what happens in the first 10 to 15 years. And, you creep up to 5.5, 5.8, 4.3, 3.3, and then you hit this 62 and 6.2 and 11.1. And that's at the same time the market crashed in both of those years, 73, 74, bad market years for the market. And then look at this, 9, 5, 6, 6.5, 7.5, 11, 13, 10, 6. It's all of this that sort of killed retirees, right? And it took a decade. That's what gives us, if this didn't happen right here, the 4% rule would have been a 5% rule or something else. It'd have been higher. This is what gives us the 4% rule, because it's all of this that made retiring back in here so ugly. That raises the question, well, what's the next 10 years look like for us? And I don't know. I don't think we're anywhere near, there's no way we can predict, obviously, but for those that are all worried about the 4% rule, we got a long way to go before we're that bad. Now, it may unfold that we have 10 years of high inflation, but to have 6 months of bad inflation and start, a lot of articles about how the 4% rule is wrong, it may turn out to be wrong, but 6 months of high inflation, a year, ain't nothing. Try living through the 70s. Anyway, good year for Cincinnati Reds, though. So we had that going for us. Steelers did pretty good, though, during that decade as well, as I recall. Okay, Sonny. So this is an interesting question. What type of bond funds or bonds are you investing in now? And what percentage of your portfolio is in bonds? I heard an interesting thing today. I watch Squawk Box in the morning. Not the whole thing, but I like those guys. They're fun. And they had someone on, a woman, I forget her name, seemed very sharp to me. What do I know? And she was pointing out that it's rare for bonds and stocks to both be down. And I've mentioned the same thing on the show. I think she said this is the 5th time or something like that in 80 years. But then she said something that was interesting to me. She said, following a period where stocks and bonds are both down, at least in the short term, fixed income turns out to be the better place to invest. Now, she wasn't suggesting moving a portfolio to 100% fixed income, but particularly if yields are going up, eventually bonds are going to look pretty attractive. Now, I don't know when that's going to happen, and I'm not changing. Again, I make these observations, but keep in mind, I'm not changing my investments at all. I'm just noting it. I think it's interesting, particularly for those that say, I don't want to have any fixed income. Okay, back to your question, Sonny. So in the mutual fund I just bought, and I replaced it with an ETF that was a little more expensive. I think it was the same Bloomberg U.S. aggregate. So basically a BND, a total U.S. bond fund. So that's most of our bonds. I'm going to have some in tips. And I say I'm going to because I had to sell some investments today, and then once they clear, I'll buy the tips. And then I have I bonds, and then I have a little bit in. I did have a little bit in a muni bond fund. I had a few $1,000s in losses, so I sold it. And we're going to need the money, I think, anyway. So I'll probably keep that in cash. But I do still think of that. Well, I don't think of short-term money that we'll need in the short term as part of my asset allocation. But if I have some cash, like for an emergency fund or whatever, I will include that in fixed income. So normally my plan was 80-20 and sort of slowly drift down to 70-30. But that was at a point when I thought, I'd be retiring and living off our investments. And at least right now, that's not happening. And I don't see that happening in the near future because, my online business, has just done better than I would have thought. So we're able to live off of that. But it doesn't answer your question in terms of percentages. And I don't have my new spreadsheet configured with the new fund that I just bought, but I should be close to the 80-20. Again, I probably wouldn't stay there if I thought I were retiring in the sense of living off my investments. I'd probably go, maybe not 70-30, but probably 75-25. Yeah, there you go. I think that's all the right answer. Mr. Mike, can you discuss CDs? About 3% today. Are they directly correlated between them and the Fed? Bank CDs versus brokered CDs? Well, certainly as the Fed raises rates, deposit account rates go up. In fact, let me just show you one other thing. Basque Bank, I mentioned it before, and a couple of folks emailed me today, and I updated it on my website. 1.5, there it is. And we can confirm that. Let me go to Basque Bank. There it is. Yeah. So it's gone up 25 basis points. I think it went up today, 25 basis points. So, as the Fed continues to raise rates, yeah, I think we will see rates go up. CD rates get a little tricky because, a savings account is basically a demand deposit account. You can put money in, you take it out whenever you want. When you talk about CDs, there's a big difference between a 3-month CD and a 5-year CD. And how banks are pricing, say, a 5-year CD, I don't know what they're looking at. Maybe an expert in banking could tell you. The risk is, you put your money in, say, a 3-year CD, and then rates continue to go up, and you're locked in, and maybe you have to take a penalty if you want to get your money out. But I can show you. Let's look at this. This will be interesting. We're going to look at 1-year CDs, and then we're going to look at 5-year CDs. So normally you would think 5-year would be a lot higher, right? Because you're locking your money away for 5 years. And maybe it is. I don't know. Let's see. All right. So here is, these are sponsored. Let's go. Okay. This is deposit accounts and other. I don't show you buy site on CDs because it stinks. I'm working on it. Anyway, make sure the comment's not in the way. In fact, I guess I can remove it. So here's a 1-year CD, the highest, and this site's pretty good about wide coverage, 2.26. What's 5-year? See, 2.26, 3.21, that doesn't seem like enough of a jump to me to warrant locking your money away for 5 years, right? I don't know. What do you guys think? That just, I'm not sure. And if we go to, let's go to a 3-year. Yeah, 301. And this is 321. So even if you wanted a little bit more than the 1-year paid, I'd never go with 5-year. So brokered CDs, these are CDs can be bought and sold. It's one way to get extra higher FDIC coverage. You can get brokered CDs at Vanguard and Fidelity, and you just have to compare the rates. I mean, there's nothing, the rates are still going to be whatever they are, and you can pull them up. I don't know let me see if I can find them on Fidelity. Fidelity brokered CDs. See if they give me like examples of what they. Well, here are the rates they give us. That'll work. So if you just Google Fidelity brokered CDs, you'll get this page. Yeah, I mean, the rates don't seem much different than what we just looked at. So, and they give you the differences. The other thing I wanted to mention, I mentioned Save Better, which is where you can open an account with Save Better, and then you get access to all kinds of different banks. They had told me that they were going to start adding credit unions. I think I may have mentioned that, and they did. Skywind Federal Credit Union is the first one. And the thing is, if you do this through Save Better, you don't have to worry about whether you can qualify for an account. You just will. And so their money market, 1.25%. Which is really good. I mean, obviously, Basic Bank is 1.5. So you can do whatever you want to do. By the way, what I was watching, okay, this is going to sound mean, but I really, Michael Saylor just gets under my skin. He's the MicroStrategy CEO, and he's basically, he's leveraged, basically, he's bet the farm on Bitcoin, as far as I can tell. Now, a lot of the debt he got was convertible. So he could just toss, maybe the shareholders take the big hit when they get diluted. Did any of that make sense? Anyway, I've been tracking Bitcoin because if it gets below 21,000, he could have a margin call. I say he, his company. So it's like I'm watching the price, eating popcorn. Like, this is exciting. But, I don't want people to get hurt. So, but I mean, my feelings on crypto. Anyway, look at this. Bitcoin now down to 22,000. I wrote about Bitcoin when it was trading under $1. Let's see if I refresh. Does it go below 22? And the answer is no, it went up. Okay. Well, there you go. All right. This is funny. Jeffrey, investor support group is now in session. Thanks for facilitating. I guess one question, and by the way, let's see how the poll, what was the poll? How'd it come out? It's closer than I thought, if I'm reading this correctly. It's 59-41. 59 no, 41 yes. How many people? 190 votes. Well, I'll think about it. I can tell you, so from an advertising perspective, I'm not sure if I would take them as an advertiser, even if I talked about them. But the nice thing is with the kind of advertisers that I have, I can say whatever I want. Like I don't have any deals where I have to like be nice. So I can tell you what I think. I would never take a deal where they could control the message. That would never happen. And I think I kind of shocked the CEO because he started off by saying, in these market turmoil kind of situations, people really, fall back on gold. And I'm like, yeah, not me. I don't think so. I'm not sure I'm not sure he kind of knew how to respond. But a very nice guy. I enjoyed talking to him. All right. Fabiana, hoping to ask this early enough so you can catch it. Well, I think you did. Considering total market fund from Vanguard, Fidelity, and Schwab, their holdings and performance are identical. So is it better to buy? I think I know your question. Yeah, to buy the one with the lowest cost per share, no, it doesn't matter. Right, they're just dividing up. No, it doesn't matter. They're just the way their shares are divided up among. You can price them in any different way. I know I'm sort of stumbling around on this. Let me see if I can go to Morningstar and we can look at this. So if we do VTI, let's do this. So check this out. Actually, we'll compare it in a different way. So here's VTI. This is an ETF, total stock market, right? And it's priced at 187, right? See that right here. Okay. This is the mutual fund version. It's the exact same fund. In fact, VTI is just considered, the way Vanguard set it up, a share class of VTSAX, and it's 91.25. So for each share of this, you're getting 91.25 worth of the total stock market, and this you're getting 187. I just don't see a difference. By the way, what were they down? This is down 4%. Yeah, about the same. So I really don't, personally, I don't know. I can think of no reason why it would matter. If anyone else can, let us know in the chat. Well, so this is vinyl. My plan is to set up a ladder of 2-year treasuries. So the idea of a ladder is, if you think about it, if you bought 2-year treasuries, you invested some amount every 6 months. And then, eventually as you got into the 2-year period, you'd have I guess 25% of your money maturing every 6 months. Really no different than a CD ladder. And that way, if prices go up, or I should say if yields go up, and then you're buying it every 6 months, you're getting that yield. And it's not, I've never actually done a CD ladder or a bond ladder, but certainly could. And you could do it with treasuries, like through Treasury Direct, or you could just do something like bullet shares. Boy, Steve, I hope it is, but you never know. Okay. You know what I noticed? I have more people tune into the show when the market is really ugly. And I get it. So, if you want to ask me some tough questions, I'm happy to do my best to talk anyone off the ledge that I can. Let's see what this is saying. Grumpy Gamer. All right. Hey, just started putting together a Roth IRA, but just sold at a slight loss to reposition closer to SPX 3500. Timing the market, but want to start at better position. Could use some feedback. But why are you doing that? What does it mean you want to start at a better position? I'm not sure what that means. I've just found that trying to time the market, It just doesn't work for me. I've never here. I mentioned this yesterday or last week, but there was and I meant to show you this paper that I found, and I couldn't find it, and I didn't look for it over the week. I'm pretty sure I linked to it in my newsletter. If that's true, I could find it. I go back far enough in my email. Let's see. Maybe. Here we go. Will I find it? Maybe I didn't link to it in my newsletter. I'll have to dig it up for next week. But the point of it was, if you think of a strategy in gambling, would be to, if let's say you're playing blackjack and you lose, double your bet. And that way, if you win, you get your money back. And if you lose again, double it again. Well, as you might imagine, it doesn't take long for the doubling to get completely out of control. But the thought is, boy, I'd have to lose, depending on how much you start with, but maybe 8 times in a row, let's say, before doubling it would just become, impractical. And you think, well, what are the odds of losing blackjack 8 hands in a row? Well, they're not very good, actually. You probably won't. So what will happen is, and I'll find the paper because they go through the numbers. You have a really high probability of making a very small amount of money in this strategy, and a very low probability of getting completely wiped out. And so it can feel like a winning strategy because you win far more than you lose. The problem is when you lose, you lose big. That's kind of the problem with timing the market. And the worst thing that can happen is someone decides to try to time the market, and the first time they succeed, because then they think they can do it. And it's the same thing with options trading. You can sell covered calls and have wins, and then you can have one that just wipes out all your winnings. All right. Yeah, the pre-live show, I probably don't see those, and I may not be able to. I'm going to end the poll. The poll ended at, well, there's more votes coming in. Yeah, I don't think I can see now the comments that started before the show. I don't think. Sorry. Let's see. Here we go. Dacian says, can I think of my guaranteed 4%? I don't know what SPDA is. What is that? Oh, single premium deferred annuity. The D threw me off. I'm used to immediate annuity. Okay, as a bond before retirement and after annuitization as a pension. Contract years 1998 to 2061. No remaining fees or penalties. Thoughts, retire in 10 years. That's an interesting question. I know very little about deferred annuities. I mean, I know conceptually how they work, but I don't know. I'm not generally a fan of trying to see sources of income, annuities, pensions, Social Security, as a bond. I prefer to say, okay, I've got all of this income that I can count on, single premium deferred annuity, pension, Social Security, whatever it is. After I count for all of that, by the way, do you like my short sleeve untuck it? After I count for all of that, what am I going to need from my investments? How much am I going to need to take out of my investments? And that's really what I like to use to drive what asset allocation should I have. Because I think that's, in my mind, it's just easier. So if I'm going to need 4% or 5% in the first year and adjust it for inflation, I'm going to want my portfolio to be somewhere between 50 and 75% equities as a general rule, based on Bengen's work. And I'd probably personally keep it as close to 75 as I could. On the other hand, if I don't need much because of your annuity and maybe other sources of income, maybe you don't need any of your investments. If you didn't have to spend them, you could go years without even touching them, then you've got all kinds of options with how you want to allocate. Probably be governed as much by estate planning maybe as anything else. That's how I like to think about it. You know, seems like the easiest. I don't know, it just fits in my mind. It's the pieces kind of click together and it just makes sense. Oh, this is a good one. Yes, David. So let me see if I can find. So Schwab got hit with a big fine, 187 million, I think. And I'll show you. So here's the deal. I've mentioned their robo-advisor, Schwab portfolio, Schwab Intelligent Portfolio, I think it's called. And Mike Piper of Oblivious Investor, great blog. He's written a lot of great books. I know Mike, although I haven't seen him in forever. Let's see if I can find his tweet. Here it is. So according to the SEC, from November 2018, Schwab's mandated disclosure of its robo-advisor product stated that the amount of cash in the robo-advisor was determined through a, quote, disciplined portfolio construction methodology, seeking optimal returns. In reality, Schwab's own data showed that under most market conditions, the cash in the portfolios would cause clients to make less money, even while taking on the same amount of risk. Schwab advertised the robo-advisor as having neither advisory nor hidden fees, but didn't tell clients about this cash drag on their investments. And it's something I've complained about. Yeah, it was 187 million was the fine. It's something that I've complained about. I've talked about it on the show. And honestly, it surprises me that it got past Schwab's lawyers or its marketing team. It's like, maybe a typical investor might not appreciate that, but plenty of people will and have written about it. I'm not the only one that's talked about this. And so it just charge some, do what Betterment does. Be upfront, charge 25 basis points or whatever. 187 million. That, I don't know how much have they made off the cash. I think they're probably in a law. I don't know. That just, yeah. So it'll be interesting to see how they change. I guess they could just change the disclosures, in which they probably already have. They probably already changed them. Anyway. So, Scott, that's a great question. And the short answer is I don't really know. A lot of things are purchased or traded in US dollars, right? Gold, oil, that sort of thing. And a lot of, obviously, foreign countries hold a lot of our cash, treasuries. So I think if this kind of thing changed overnight, of course, that would probably wreak havoc on financial markets around the world. If it's gradual, though, I don't know. One thing that's beneficial for countries is to be able to borrow money in your own currency, right? But of course, a lot of countries can do that, even though their currency isn't, the reserve currency of the world. The other thing is, you look at other countries that aren't in our position economically, Germany, England, all countries have their issues, but they're doing just fine. I know we've sort of been in the number one spot for a long time, and I suppose we don't want that to change, but I'm not sure that, being number two at some point down the road, I don't know if and when or how you measure that, maybe not even related to reserve currency issues, wouldn't be the end of the world. I'm not trying to hasten that event, but I don't know. I just don't lose any sleep over it. The other thing is, right now at least, what's the alternative? China's currency? I don't think so. Not right now anyway. The euro? It's probably the kind of thing in today's world that would happen gradually, and then maybe there wouldn't be a replacement. Maybe there wouldn't be any one currency that stands out as the reserve currency. I don't know. I'm not an economist. I guess that would be an economist kind of question. Anyway, it's certainly well outside my wheelhouse, which my wheelhouse is pretty small anyway. In my wheelhouse, it's tight. It's a tight corner. I don't have a lot of turning around room. All right. A lot of people mentioning the Schwab robo-advisor situation. Well, let's see what we got here. Banana Maltastic. All right. I terminated my advisor for my Roth IRA, 1.65% for 15 ETFs, a glorified 3 fund. Doesn't it just burn you up? It just toasts my buns. Seriously, this should not be permitted. But, I know we can't really outlaw it, I don't think. But that just is ridiculous. It's now at 20% cash, and I don't know whether to lump sum or DCA it back into the market. What would you do? Well, I lump sum. I just lump sum today. So I'd been trying to figure out exactly how I wanted to simplify my portfolio. I tried the iShare Core ETFs, but I knew I wasn't going to stick with them. And I just, bought the Vanguard fund in my wife's rollover IRA and mine today, all of it, 100%, boom. I will say I kind of got lucky because I was out of the market today and Friday as I was doing these changes, but over 50 or 60 years of investing. Yeah, that's what I do is lump sum. So that's what I would do. People are referring to robots. I'm not sure what we're talking about. By the way, I finished Ozark. It's a dark show. It ended on a very dark and down note, in my view. I guess that shouldn't take me by surprise. It's not exactly the feel-good show of the year. All right. And welcome from Cincinnati. It's just good people live in Cincinnati. It's just the way it is. Okay. Peter, how do you factor in receiving a pension in your decision to choose Roth versus PreTax? Does the pension, which is going to be ordinary income, favor Roth or load up on catch-up contributions? Well, it's a good question. So the way I think about the decision of Roth versus PreTax primarily is, will my tax rate be lower at the time I make the contribution or do a conversion, if I'm doing a Roth IRA conversion, or when I spend the money in retirement, or take it out, either because I spend it or because I eventually get to the age of required minimum distributions. And as I've said in the past, it's an analysis that's almost impossible. There's too many unknowns to figure out what your tax rate's going to be, when you retire. Even if you're close, like, I'm closer than many of you, there's just so many unknowns. So I try to think, okay, well, if nothing changed, what would my tax bracket be then, and what is it now? I use new retirement as a way to sort of figure that out, but it takes some effort. And yes, it's more than just tax bracket, right? Because increasing your taxable income can affect other things like your Medicare premiums or how much of your Social Security is taxed. And so, it's more complicated than that, but I don't worry about precision to that degree for the most part. I think if I were at the age of starting to get Social Security or Medicare, I'd factor that in if I were making these kinds of decisions then. But to answer your question, it will, because I think the pension will matter because, I don't know what age your pension kicks in, but you've got a pension, presumably you've got Social Security on top of that. Let's assume. So if you start then withdrawing, let's say because of RMDs, you start withdrawing from a traditional pre-tax retirement account, that's going to sit on top. And now I don't know how much money we're talking about, so you have to figure all that out. But that could increase the taxes you pay on it, and that's what you'd want to think about when deciding whether a Roth makes more sense now, or an IRA, or at some point a Roth IRA conversion too. It would be the same sort of analysis. So yeah, I think just sitting here now thinking it through on this live show, yeah, I think it would matter because it would be relevant to figuring out your tax situation in retirement when you're receiving the pension. So that's it. That's my answer. C. Okay. It's always C. It's always the answer. Yeah. Thorin, a solid financial plan can protect against inflation, but what about hyperinflation? I understand that the odds of this occurring are very low, but I'm still a bit worried about this. Yeah, I get it, but I'm not really sure what the answer is for that. I can't think of any sort of, I guess you could say, tips. I mean, would they be going up by 150% if we hit hyperinflation? I kind of think other bad things would be happening that would eclipse our concerns over our portfolios, but maybe not. But I don't think there's any sort of financial maneuvering that I'm aware of. I mean, inflation is like finding poop in the punch bowl, right? I mean, you can't just scoop it out and keep drinking. The party is over. You know what I'm saying? And hyperinflation, I don't know, maybe you guys have some good answer for that, but no debt, that would help. Although one could say hyperinflation, maybe you should have all kinds of debt, but I just like the idea of owning, owning where I live and being able to handle things like that. So anyway, now I've lost my place. I may have skipped some. I don't know. Anyway, if inflation continues and or recession comes, do you see any buying opportunities? Well, there could be, sure. Right? I mean, if interest rates continue to go up, asset prices are going to come down. There could be great opportunities in real estate, right? I think there are some good opportunities in the market today, but I don't see the current market as some sort of, crazy buying opportunity. I don't see it that way. All right. My stream, I'm trying to see, my stream is sort of jumping around on me a bit. And I don't know why. Ethan, what is your credit card strategy? We just started using an Amex for 6% on groceries, Fidelity 2% for everything else. Are we missing out on additional cash back? Well, so I use the Bank of America Premium or Premier Rewards card. And if you have a certain amount at Bank of America and or Merrill Edge and have a checking account there, you get, depending on what you're purchasing, either 3.5% or 2.62% on everything. That's the lowest. So I think that's probably the best sort of flat cash back that I'm aware of. So that's our primary card. And then we use the Apple card, but just for Apple purchases, that's 3%. We use Amazon Prime for Amazon and Whole Foods, and then that's it. Amex is a decent card. I assume 6%, so you're talking about the Amex Blue Cash Preferred. I can show you this on my site. I'm just writing about it, just updating the Amex Blue Cash Preferred card. Sometimes I worry about the fact that it's like maybe I know more about credit cards than I should. It's like, you're at a party. So what do you do? Well, I can tell you anything about a credit card. So they increased they call it a welcome bonus, by the way. They don't call it a sign-up bonus. It's a welcome bonus. Welcome. Here's some cash. You got to meet the spend requirement. But one of the things they did, they used to waive the fee the first year. Oh, look at that. It got big. They used to waive this fee the first year. They don't do that anymore. So you get hit with the 95 in year one, which you didn't used to get hit with, but they gave you $50 more on the welcome bonus because it used to be $300. But I don't know. My math says that's $45 to the bad for us. But still, I'm being a little goofy. $350 is a pretty good cash bonus. The 6% is limited on $6,000 per year in groceries, but you get 6% on streaming. So that could come in handy. You get 3% cash back on gas. So, it's a good all-around card. But if you only wanted to carry one card, I think a 2 or 2.5%, or in my case, the Bank of America card would be better. If you're willing, like you are, Ethan, to carry two cards, I think this is a really good second card. The only thing you could be missing out on is if you travel a lot. And if you travel a lot, then probably, let's see what I've got in here. By the way, this I like this. So I've got help. In fact, Matt might be listening to this right now. He helps me collect all of this data from publicly available sources about these are just folks that have gotten approved or denied. These happen to be all approvals, but we look for denials too. And on forms and whatnot, they say, okay, well, this was my credit score, and this was from which bureau, and this was the limit I got. These limits seem awfully small to me. for the Blue Cash Preferred, $1,000. Of course, the credit scores are a bit lower for this card, so maybe that explains it. Anyway, a lot of the cards on the site, we have that data, and we're working on it. In any event, I was going to see, yeah, if you do a lot of travel, then there's a couple of different options. It depends if you want a brand specific card because you stay at the same hotel and the same airlines, and you just go with theirs. It might be okay. But more broadly speaking, Chase Sapphire Preferred card is definitely a good card to get for a good all around travel card. A big sign up bonus. You get 25% bonus on your points when you book travel through Chase. The Reserve card I carried for a long time. It's a little more expensive, but it's an option. So, but I like to keep things simple. So we have the Apple card we really don't use other than Apple. We have Amazon Prime and the Bank of America card. Okay. See, I went down that credit card rabbit hole. Yeah, so Joshua, I'm very familiar with FFNOX. And I'll pull it up. It's the issue for me was the stock bond allocation was the problem. But I like the fund. In fact, I was talking to a friend who has this fund. Here it is. So yeah, it's 11 basis points. And if we look at, well, we can look at it here. So it's got 50% US, and it's basically total market. They divide it into two funds, but it's basically total market. And they have international, right? They have a separate allocation of emerging markets. So this fund here has exposure to emerging markets. In fact, we can look at it. Here it is. We go to composition. I know I'm moving around this kind of quickly, but this is like the Vanguard International Fund. I'm pretty sure it has, that's interesting. It doesn't have any. This is not like VXUS. I stand corrected. None. Okay, so that's why they separated out. Anyway, it's got emerging market. Investment grade, this is the Fidelity US Bond Index Fund. This is like B&D, I'm pretty sure. I guess I should check now. Maybe I'm starting to doubt myself. It should just track the Bloomberg Ag. Yeah. Oh, yeah, Bloomberg Barclays US aggregate right there. And then it's got... one thing I don't like about this fund is it does have 5% in long-term treasuries. And it doesn't have tips. But a lot of these funds don't have tips, these sort of multi-asset funds. But the thing that doesn't work for me is when you add it up, you see 50, 75, it's got 85% stocks, which when I pair it with the rest of my portfolio is just too much. I needed something closer to 60-40. But if 85-15 works for you, yeah, I like FFNOX. Good fund. Kevin, I hear you. I mean, life is short. I'm not a motorcycle person. But I guess that's really not relevant. So do you think the sequence of returns since 2020 would cause the 4% withdrawal rate to fail? Definitely not. No way. Now, could we have more bad years? And eventually it could, sure. But you'd still need inflation to stay high, I think. But if you look at, let's just look at Stern Business, S&P 500 returns. I'm just going to pull up their data. Here it is. So if you look at, so this first column right here is the S&P 500 returns. Let me get, there we go. And if we go all the way down to 2020, returns have been actually really good. I mean, 2020 was 18%. I guess my name is in the way, but you can kind of see it. And 21 has been 28.4. Now I know this year we're down, whatever, 20+%. We'll see how the year ends, but now you would need high inflation and a more prolonged, really bad market. But it could happen, right? The probably go to 73 and 74. These two numbers, -14 and -25, don't seem terrible, particularly when they were preceded by 14 and 18 and afterward, 37 and 23, right? These numbers right through here, I mean, I don't know. They look pretty good to me, but inflation walloped everyone. Inflation was what. So inflation's what did it, but you have to understand, as a withdrawal methodology, the 4% rule is a very extreme approach, right? Because it ignores portfolio balance. It focuses only, well, it doesn't ignore it in year one. You take 4 or whatever your percent is of your portfolio. But after year one, you completely ignore your portfolio and market returns. And all you do is, like a robot, focus on inflation and just march and step and increase with inflation. I don't think most people do that. But that's a very extreme approach. The opposite side of that would be one that ignores inflation and only focuses on portfolio value. So that would be an example of the RMD approach. You could calculate what your RMD would be at any given age with life expectancy, and use that and your portfolio balance. So you're ignoring inflation. You're doing the opposite. So 4% rule is an extreme because it more or less after year one ignores the market and focuses just on inflation. The RMD approach to calculating your withdrawals ignores inflation and just focuses on the balance and how many years of life expectancy you have left. So what that means, though, is in a year where the market drops by 25%, you're taking out a lot less because you're going to apply the formula to a much smaller balance. And so I think some compromise, some in the middle is better. And guardrails is one way to do that. We've talked about that on the show. Okay, how did the, let me just see if people are still casting their, oh yes. The poll is narrowing. It's 54% no, 46% yes. I don't know. Yes, Masterworks is from Phil here. That's the one that keeps contacting me over and over and over again. They have peaked recession coming. Maybe. I don't know. I don't know a thing about the art world. All right. What time is it? 8:07. Okay. I'm watching Stranger Things now. I don't know. I love the fact that it's set in the 80s. That to me is the best part of the show and the kids. But it just seems like each season they decide they need to try to get weirder and weirder. I don't know. Yeah, so one thing I'm trying to do on Fundrise, so Fundrise is a crowdfunding real estate investment. I have someone that I know that basically started their own real estate investment vehicle called Open Door Capital. And we're exchanging emails to get him on the show. By the way, Mark Zorro will be on the show live Wednesday morning, 8 a.m. to talk about expats and what, issues if you want to move overseas or you live overseas, or I guess folks that from other countries that have come here. So that'll be fun. Oh, I forgot to tell you. How can I forget this? So last week we talked about the bucket strategy a little bit, and Harold Avensky. Well, guess who emailed me? Mr. Avensky. And we've chatted through email. He sent me some resources, one of which I'd read, a paper that he and some other folks wrote. But he's going to come on the show live. I think the plan is live. Won't be until probably July. We're working on a date. That'll be fun. All right. Able, a black pen, I'm not sure. Someone 42. A bond question. How are the interest rates calculated? Understand the concept of the fixed and variable rates, but can't find the formula. Well, so the formula on the interest rate is just the changes in CPI. Just add them up for the previous 6 months. There is no formula for the fixed rate. The Treasury Secretary sets it. And so, yeah, no formula. And I actually researched that. It'd be interesting to see if the fixed rate goes up in November. I think there's a chance it could. I guess there's always a chance it could, but. So this is a good question from Sober Money. Want to know about U.S. aggregate bonds, which is an intermediate term bond index, versus short term. And let me see if I need to do a better job of keeping these papers handy. I'm working on it. Morningstar short-term bond versus long intermediate term bond. There was an article they had recently. Here it is. I think this is it. Maybe I'm wrong. Let's see. The answer was intermediate is the best. The best may be the wrong way to put it. I don't know if, I don't know. I thought someone else wrote the paper though. Let me, I'll show you this in just a second. Bear with me. That was March. That must be it. Oh, wait, no, that must be it. That must be the paper. Well, I'll show it to you. I think this is it. Let me get hide the comment. This is from Christine. Which bond types provide the most diversification for stock investors? If this is the correct article, they were concluding that intermediate term over the long term provides the most great diversification, and its returns are not that far below long-term bonds. I'm pretty sure. Now let me see if, what's this report they're referring to? So I guess you could put your email in there and get this report. But I thought there was another article, but you can check this out if you want to read on it more, read more about it. I've always been comfortable with intermediate term. Yeah, alternative. So what does alternative invest? I don't know what like the official definition. Let's see if there is one. I would certainly put crypto. Well, I don't even really think crypto is an investment, but people would call it that. But you think investments beyond stocks, bonds, right? So precious metals, I would put in that category. I guess real estate could be. Let's see. I'm just seeing if they have other examples. Well, there's private equity and that sort of thing. Here's an article from Harvard Business School. They've got private equity, private debt, hedge funds, real estate, commodities, so that would include precious metals, collectibles, structured products. I have no idea what that is. So that kind of thing. Art, and that would be an alternative. Oh. From Ethan, you always caution that the investment's in a taxable. Is 100% BKRB in my taxable the move? Well, certainly if I had to pick one stock to own, that would certainly be high on my list as maybe the best one because it's the closest stock to a mutual fund that you could probably find, I think, at least that I can think of. But my question to you, Ethan, would be why not just low-cost index funds? Now, I own BRK, BKR. I own, it's BRK, BKR. Yeah, BRK. Yeah, it's BRK. I own BRKB. But it's very small compared to our overall portfolio. And I own most of our taxable investments are in 3 mutual funds, a total stock market, small cap, and a international. So even though Berkshire is very well diversified, I think some might even actually argue with that. I mean, it's definitely got a lot of financial exposure, energy, but it owns a railroad, insurance. So I think it's a great investment, but I guess my question would be, why pick that over an index fund? Just a question. All right. Greg, I don't I don't even know who that is. Maybe someone else has mentioned him in the past. Invest and protect. I generally am not a fan of protection strategies. I'll check it out. I'm not familiar with them. But thanks for mentioning that. I'll look into it. All right. Andrew, first-time caller, long-time listener. I have cash. I am wondering when is a good time to put my chips on the table. Inflation is eating the cash, but it's better than a negative 20% in VTI. Well, if you're a long-term listener, you know my answer. You can answer this for me. I don't need to answer that. Right? I mean, I just invested. If that's what I'm going to do, I don't need it long-term. Michael, please conduct insightful, not just polls. He wants insightful ones during the live cast. Well, what kind of insightful poll could I? I'm going to end this one. It was close, so I don't know what I'm going to do with that. I don't know. I don't know what to. I'll think of something. I will do that. They are fun. Slim Dog. How do you actually do the math to calculate withdrawal with inflation adjustment each year? Well, you could just wait until the December numbers come out if you're doing it on a calendar year, and it'll tell you what the year-over-year inflation was, and then just increase it by that amount. But I think as a practical matter, most people probably don't do that. They figure out what their budget is. They've probably got some idea of their monthly budget. If prices are rising, they see that in their monthly budget. They know what they're going to need the following year. Most people, I think, don't live to the number of a budget. I mean, if you're getting by paycheck to paycheck, you live by what's in your checking account often. And I get that, and I've been there. When you get to retirement, we talk about these things with some level of mathematical precision, but my gut tells me that's just not really how it works for most people. But if you wanted some idea of, what your spending would be if it didn't go above the inflation adjustment, that's how I would do it. You could use the January numbers. Depends, when you take your money out. But yeah, I think that's how I would do it. Josh, what percent allocation do you recommend for the stock side of a 70-30 with total US, small cap value, international, and REITs? So back in the day, my portfolio was not 70-30, it was 90-10, but I would put, the way I did it, I had 10% in REITs, 10% in small cap value, about 20% in international, maybe 25, but that was divided between developed and emerging back in the day. This was I'm just sort of describing the portfolio I had for, 20 plus years. And then the rest in total US stock. Now, you don't have, so yeah. Today I wouldn't separate out emerging markets today. I would just get like VXUS, or I use VFWAX, which it doesn't have small cap exposure. Now VXUS only has about 4%. But I switched from VXUS, or I was using the mutual fund version for tax loss harvesting at the end of 2018, I believe, when the market went down, and I went over to VFWAX. I think I've got the ticker correct. So that's what I would do today. I probably wouldn't. I just wouldn't separate out emerging markets and try to over allocate to it. The older I get, I don't know. I just kind of move away from that. Again, it's not that it's right or wrong. Oh yeah, so it's a good question. Passive 101. So, well, you could look at the best way is to look at the prospectus. And so shares with front loads are going to be A shares. I think that's universally true. Maybe there's some exceptions. So American funds, A shares. Let's just find one. I'll pull this up. American funds, what we offer, mutual funds since 1931, blah, blah, blah. I'll show you what I'm looking at. Whoops, what did I click on? So, we'll just use this. This is a Capital World Growth and Income Fund. Here's the ticker. I don't know a thing about it. And they have different share classes. So let's start with A, and we want to look at fees and expenses. So let me go back to summary, because there's got to be a front load to this. Am I missing it? There's got to be. There's got to be a sales charge. Oh, here we go. Does it not tell you? Am I missing it? Does it not tell you? It should be 5 3/4, but 7 and 8. Look at this. We got to go all the way to the bottom of the page. Wow. Thank you, search and find. Seek and find, whatever it is. 5.75, right? So that would be when you buy it. Now, I think the C class have the fee when you sell it. But boy, I haven't dealt with this in a really long time. So I guess we need to go down to the footnotes. Again, you'll find all this in the prospectus, but, and I could be wrong about the C classes, but yeah, here we go. Class C shares reflect the deduction of contingent deferred sales charge, 1% on shares sold within the first year of purchase. And I think that's how deferred sales charges typically work. It's some percent, but after a certain period of time, it goes away and you can sell without that fee. This one happens to be 1 year. I think there's much longer. There could be 5 or 10 year deferred sales charges. So anyway, I don't know if that helps, but there you go. Appreciate the kind words. So far in all the live streams, no one said in the chat, Rob, you're a complete idiot. It could happen. Oh, there's VJ. Go Buckeyes. Great video on getting rid of investment advisor. Well, thank you. And it even applies in Michigan, I'm pretty sure. Okay. This is funny. You know, so there's a one question that's interesting to me is tips versus I-bonds. Now I understand with I-bonds, you got to buy them directly. There's a limit, but putting those issues aside, they're important. Which one's better? And Bill Baldwin, who was the former editor at Forbes, he wrote an article. I was just talking to my editor at Forbes today. They want me to write a piece on basically the 4% rule in light of inflation and everything. So I'm going to do that. But he wrote an article. I think he's a big fan of tips. Here it is. Yeah, just last week. I haven't read this, but here it is. He's sort of retired, I think. He's now a senior contributor. Whoops. I-bonds and tips compared. Which are a better buy? I haven't read it yet, but it might be worth a read. By the way, if you haven't subscribed to my newsletter, there's a link below the video. This is the kind of thing I have to read it to see if I'll put it in, but this is the kind of thing I'll put in my newsletter. And, if I think it's interesting, it goes out every Sunday. Anyway, okay. She mentioned that article, thought it was pretty good. There was another article she mentioned. It was also on Forbes. I started to read it. It looks pretty good. I'll show it to you. You can Google it. I don't know this person, Christopher Hellman, but works for Forbes. Over a barrel. ExxonMobil preps for the... Is this the right article? Nah, it's not the right article. This is one that was just published. Maybe this is it. Oh, yeah, this is it. Yeah, I have to sign into my Forbes account to show you. Oh, my goodness. They started doing this on some... let me sign in. If I can. Okay. I don't know my password at the moment. Yeah, I know. It's embarrassing. Get ready for $8 a gallon gas. That's the article. Looked pretty interesting. I would show it to you, but I can't. So, I mean, would anyone buy that? That can't be right. 10-year CD at 2.2, who would do that? I guess if you thought rates are going to go up, but then they're going to crash back down after the supply chain resolves itself. I guess. I don't know. $43, 120 grand, DCAing 5 to 8K, I guess a month, I don't know, into VTI and VOO with every 5% drop. So yeah, I mean, I would, I'm more of a lump sum investor. If you want a DCA, I just do it monthly or quarterly. One question I have is why VTI and VOO? Because there's a lot of overlap, right? And in fact, I did a video VTI versus VOO. Long term, the performances are very, very similar. So that's just a question. It's not like that. It's bad to have both or anything. Just curious why. All right. Red Robin, can you make some videos about your experience as a lawyer? Okay, here we go. Question. Do you want to hear more about my, I'll say, career/business experiences? Yes or no? Did it work? There it is. I will tell you, I grew up in Ohio, middle class, maybe lower, sort of lowerish middle class, maybe. Very little traveling as a kid. Our biggest vacation was driving a ginormous Ford Thunderbird with a bass fishing boat hooked to the back down to Florida. We did that twice. Naples, actually. Stayed at a little motel. That was fun as a kid. I enjoyed that. And then, I go to college, I go to law school in Boston. So that's like, I'm from a suburb in Ohio, Columbus. And so now I'm in Boston. That was a pretty big experience. And then I go and I work at Winston and Strawn as a summer associate and an associate, which is a big international firm, a lot bigger today, but it was big then. And I'm going to the Kennedy Center to see plays and taking little boat cruises out to St. Michael's here in Maryland, and ended up working there and having cases in Alaska, all over the United States, and traveling a lot, and that's just all very new experiences for me, and it was a lot of fun. But anyway, I'll let the poll decide what I. One thing that I do think could help people maybe is so. My sort of side hustle, if you will, is running an online business. And YouTube channel is what you guys see, but I have the websites that I've showed you, but I understand search engine optimization, building websites, WordPress, understanding the types of content that people want to read and that I want to write, and how to monetize it. But that seems, oddly specific and not really relevant, at least directly, to an investing and retirement channel. But I could do some content on that if you guys find that interesting or useful. All right. Searching for more questions. So here's another one example, Acre Trader. So I've met the people behind Acre Trader. They're actually technically a partner, although I've never done anything really to promote them. And I like the concept. I like the idea of buying farmland. For me personally, I don't like the idea of an illiquid investment and another account to manage. However, that doesn't mean you wouldn't like that. And farmland to me could be an interesting way to diversify a portfolio. So that is something that I'll probably do something about. Maybe I'll bring them on and interview them and ask them a ton of questions. There's tax considerations to factor in. Again, you've got liquidity constraints, which you have to understand. And the other thing, these investments have minimums. So for example, let's see if they've got an investment live at the moment. Yeah, the minimum investment's not huge, but like this one, Round Lake Farm, I don't know a thing about it. Minimum investment's $18,500. And if you look at the details, they've got estimated ownership duration, 5 to 10 years. So I think it's an interesting idea, and I will cover that. But again, I don't know. I don't want to complicate my portfolio. I want to keep things simple. But again, maybe you don't. Maybe you don't think that. You think farmland would be good and you like the diversity. And I get that. Well, so Jeff wants to know if there's anything wrong with buying the downward trend. So here's my first question. That tells me you have cash that you want to invest, and you're waiting to invest it until some, I guess, price point or whatever. And I think it's very difficult to make that work long term. If we look at things now, most of us would probably say things are going to get uglier and, inflation's still bad, rates are going to go up, everything could come down. But the reality is we don't know what the rest of the year is going to look like. If someone says I want a dollar cost average, as you know, I'm fine. You're not going to get any grief from me. But buying the downward trend, what does that even really mean? And do you have your plan written down? And what are you going to do if you've got it written down, this downward trend, and it stalls out in the sense that the market stops falling? Maybe it goes sideways for a while. Maybe it goes up. Do you wait a year, 2 years? I don't know. Of course, if you put it all in now and the market goes down another 20% at the end of the year, well, I guess you could stop watching the show. Yeah. That's my answer. Not the stop watching the show part. QVAL and IVAL, they are quantitative value funds. Okay, they're already above my pay grade. Already, I'm confused. Oops. Alpha architect. So any fund with the word alpha in it, I'm out. I'm out. Alpha, it's a marketing. I don't know anything about the fund, but alpha is this idea that you can get returns over and above what the market would give you anyway. Very few, I think, actually get alpha. So here's the portfolio. Let's see what they invest in. So here's QVAL, 49 basis point expense ratio. I don't know. This may not tell us what it actually invests in. So it's U.S. equities mainly, mid-cap value. Look at the price earnings. 570. This is a serious value fund. It owns 50 equity holdings. So this must just be like a small to mid-cap value fund, but you can see that's where it's investing. Let me go to the website. So I'm a big fan of value investing. What I don't know is how they pick their stocks. And I would need to, dig into that. That'd be the question for you to figure out. How, maybe you know the answer, but how do they pick their stocks? And I guess I'd have to dig in. Whoops, I didn't mean to do that. Fund documents. Let's go to overview. Well, the overview certainly doesn't tell you much. I guess we'll go back to documents. We'll download the overview. What do we get? Who we are. There they are. Yeah, I would have to dig into this. See, this is one of the downsides to these kinds of funds. You really need to understand what they're doing. And that's not something I can just look at this and tell you. But I will say this about the fund, just looking at it, it has potential. And why do I say that? It's an actively managed fund, but it's only 49 basis points, which is a really cheap actively managed fund. It's highly focused. There's no point in having an actively managed fund that basically mimics an index, right? Which a lot of funds will do that. Closet index funds, just buy the index and spend less money. But it doesn't look like, just for what I've looked at it briefly. And they're value focused, which is, I think, particularly when you're picking a relatively small group of investments, is generally the approach that resonates with me. Now, having said that, I don't know. I'd have to look at detail at their track record. I don't know how old are these funds. Let's look at performance real quick. They've been around for a while. Here's their performance. We'd have to figure out what to compare it to. You wouldn't compare this to an S&P 500, right? Because it's not a large cap blend fund. So you might compare it to like a Vanguard mid cap kind of fund. But this is a fund that if you were interested in pursuing an actively managed value-based fund with smaller companies, this would be on my list of funds just based on, again, this is what, 2 minutes of looking at this thing. It would be on my short. I'd dig into it more. I'm not going to do it because I don't have any interest in that kind of fund, but all right. It's 8:37. I'm past. Wow. I'm 7 minutes over. All right. Let me just scroll through here. I'll go to the bottom. Oh, let's look at the poll first. What did you guys decide? So I think some of you basically said, Rob, I really don't want to hear about it. 32%. I get it. 68% said yes. Now the question is, what would I say about all of that? I'll have to think about it. Like, I could do in-depth how-tos. I could do in-depth how-tos on how to build an online business and make money, but almost be like a different YouTube channel. I don't know. I actually thought at one point of creating, maybe I could do this. I don't know. Creating a YouTube channel. And every morning when I stumble down here and I start working on my business, I just hit the live stream like I'm doing now, turn on my screen so you can see it, and I just start working. And anyone that wants to join me, chat, and I'm working on my business. So there's no effort in terms of pre-recorded videos. It's literally turn on the camera. Well, actually, my camera's on 24/7. Hit the live stream with a brand new YouTube channel. And anyone that wants to join me to talk about building online businesses, we can do it. I don't know. Maybe that's a dumb idea. I will say that, I sold most of my sites in 2018, and then the non-compete expired, and I sort of built things back up. And as I was building things back up, I thought, what if I can't do it again? I mean, I learned a lot. I started this in 2007, but maybe I certainly did get lucky, timing wise, and lots happened. That was 15 years ago, and I was surprised at how smoothly things went and how quickly I was able to build it back up. So I feel very fortunate about that. Anyway, I don't know. Maybe I do a different YouTube channel. Just hit the live record button, and anyone that wants to join me at like 6 in the morning. My best days are actually when I get up at like 4:30 or 5, which I don't set the alarm, and I come down here and start working. And by like 8, 7, I've gotten a lot done. Yes, that's true. All right, let's go all the way down to the bottom. I'm going to call it a night. Books for young investors. Yes, actually, someone emailed me a book because you guys asked me that last week. What did I do with that? Book, young. I'm not going to be able to find it. And I don't remember the name. Let's see if I can find it quickly. Probably not. Okay, maybe. Bear with me. By the way, did you see that Discover, which used to give non-card members access to their credit, has shut that down? I can't put my hands on this book quickly, I'm afraid. And I don't remember the name of it. Oh well. If I find it, I'll mention it next week. All right, gang. I'm going to call it a night. I'm kind of tired. This has been exhausting. Have a great week. Be interesting to see what the market does. You know, if you want to watch it, feel free not to. Again, Lord willing, and the creek don't rise. I'll be back next Monday. Yes, at 7. But on Wednesday, 8 a.m. Eastern time, Mark Zorro will be on the show. So if you can join live, please do. If you've emailed me questions, I've kind of collected them all, and we'll probably group them in some way, but try to cover as many of them, if not all of them, that we can. So that's Wednesday at 8 a.m. Eastern time. If you can't make it, of course, you can watch the recording after the fact. All right, gang. Appreciate it. Remember, the best thing money can buy, financial freedom. Much better than like a hedging strategy.